Let's get into the markets now. Chinese and Hong Kong shares continued their surge during the trading session, although their closes were mixed. Securities regulators' intervention to halt the downward spiral seen in stock valuations in previous weeks played a role in keeping sentiment upbeat. But a big question mark remains as to whether regulatory intervention will be sufficient to keep share prices heading northwards. The Nikkei share index ended the day down 0.11%. The Hang Seng index closed in the red by 0.34%, while over on mainland China, the Shanghai Composite Index continued its upward push, closing up 1.44%. Over in the United States, the S&P 500 closed slightly higher on Tuesday as investors scrutinized a mixed bag of earnings at big U.S. companies and digested comments from Federal Reserve policymakers for clues about its first planned interest rate cut. The S&P 500 gained 0.23%, the Nasdaq Composite gained 0.07%, and the Dow Jones Industrial Average rose by 0.37%. Well, the JSE is trading mainly weaker. The all-share index has shed 0.4% to 74,248 index points. The industrial 25 index has added 0.4%. Financials are 1.1% lower. Markets in Europe are mixed at this hour. Britain's FTSE 100 as well as Germany's DAX are 0.3% down, and the CAC 40 in France is 0.1% up. Looking at commodities, gold is trading at $2,033 and platinum at $901 per ounce, while the price of Brent crude oil is hovering at around $79 a barrel. The rand is trading at 18.92 against the US dollar, 23.89 against the pound sterling, and 20.36 against the euro. All right, to break down the markets for us, I'm joined by Han Tan. He's a chief market analyst at Xinity. Thanks very much, Han, for joining us. So, of course, we do see, right, that the US is halfway into its earnings season. And apart from earlier hopes of imminent rate cuts, this seems to have kept the market rather buoyant. But how sustainable is this going to be, do you think?
Yeah, I think this gains in U.S. stock markets will be sustainable if these AI companies can actually live up to these already lofty expectations, right? And we saw that just in recent weeks, whereby you've got some companies like Google, for example, that missed expectations and their shares saw a steep drop. So I think AI is obviously a big driver of U.S. stock markets overall, but you're right to point out as well, if the prospects of the Fed lowering its interest rates, if those prospects become brighter, that should offer another supportive element for U.S. stock markets as a whole as well.
So if we head to the Chinese market, I mean, the regulatory intervention in China to stem the bleeding in stocks, you know, that's a good thing, but surely the fundamentals of that economy should be what ultimately drives sentiment, because people need to look at a company and say, this is worth investing in because its fundamentals look good, not just because that, you know, there's suddenly some stimulus.
Yeah, 100% agree. Although I will just make that distinction. Yes, there has been intervention that we have seen. What markets really want to see is more policy support that can shore up the real economy, as you pointed out, right? So if we see more of that economic support coming in, and then also it feeds into the economic data that we get after the fact, I think that will really set the tone for a sustained recovery in Chinese stocks, because otherwise you're right, markets are willing to look past some of these interventions as mere stopgap measures.
So we're hearing talk of a possible Middle Eastern deal to quell the tensions out there. We see that the Secretary of State, Antony Blinken, is in Israel today and really talking the talk that peace may be imminent. We know that this situation has been affecting oil prices or sentiment around oil. Do you think that if a deal is struck, this could keep the price of Brent crude oil below $80 a barrel?
It could, but to be clear, look, these geopolitical developments, right, they tend to have a relatively fleeting impact on oil prices. It goes back to our earlier discussion about making the distinction between intervention and, actual policy support, right? Similarly, with oil, you make the distinction between the geopolitical noise versus the fundamentals, right? Supply, demand. And currently, I would argue that the bigger driver for oil prices is the weaker global demand that we're seeing right now. So until these central banks in major economies come and support their respective economies and shore up demand for oil, yeah, you're right. I would suspect that oil would be kept below that psychological $80 per barrel mark.